Thank you, Mr. Chairman. Good morning, Mr. Chair, Chair Powell, and thank you for being here. Last week, the FOMC decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. While I was not surprised by the decision to hold rates steady, I was surprised by the committee's revised forecast since March, which represented a decrease of 0.3 percentage points for GDP, a similar increase for core PCE, and an uptick in the unemployment rate to 4.5%. Can you explain the incoming data that the committee has seen since March that caused it to make these adjustments?
Sure. So, first of all, these are individual. This is not a committee forecast. These are just individuals submitting their own personal, forecasts, and we don't bless those as a committee. But I think people are looking at the incoming data and having a range of different judgments. If you look at the range, if you look at the central tendency, you'll see that it covers quite a wide range. Those are the medians that you're talking about. I think so. Inflation is projected to have moved up because of what we've seen, particularly from tariffs. And I think if you look at other outside forecasters, you'll see very much the same thing.
And what data are you looking for?
Well, we look at the incoming data on, we look at our own forecast, and we ask ourselves what's likely to happen. Monetary policy has to be forward-looking. A forecast is a prediction of what's going to happen in the future.
Thank you. In its statement, the committee announced that it will continue to monitor the implications of incoming data and adjust the stand of monetary policy as appropriate. Some analysts predict 2 rate cuts by the end of the year are still on the table. Is this a fair and accurate assumption? And what incoming data will the committee need to see to consider these cuts?
So what will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty. I mean, we will, the story has been evolving, and our thinking has been adapting, and that will continue.
Thank you. Chair Powell, although a ceasefire has been tentatively reached in the Middle East, the situation still has the potential to open global and energy markets, especially if the ceasefire is broken, while at this point Iran is seen as unlikely to close the Strait of Hormuz. That decision could change. How is the Fed assessing the current situation and incorporating those assessments as it considers future adjustment to economic projections and its stand on monetary policy?
So I think it's too early to know what any economic implications might be, and I would not want to speculate. Like everyone else, we are, of course, watching the situation.
Thank you. And Chair Powell, after reviewing the economic data following the meeting last week, it seems to me that the committee is indicating that we could be headed for a situation where inflation accelerates while unemployment rises and growth becomes more sluggish. In this scenario, this will put the Fed's dual mandate of maximum employment and price stability in tension with one another. In this scenario, how does the Fed balance these priorities in order to achieve both mandates?
So let me say that we're not facing that right now, and that isn't really our forecast that we will face such an issue in a serious way. But if that does happen, then what we do is we look at the 2 goals and we see which one of them is farther from its goal. 2 variables, is maximum employment or price stability farther from its goal, and we prefer the one that's farther than its goal. And then we also ask ourselves, how quickly will they return to goal? it's a very difficult situation for any central bank. And, I would say, again, we're not in that situation right now.
Thank you, Mr. Chairman. Yield back.